And a big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show topic today is who are the consolidators in digital health? This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We have new podcast show links, so make sure you're seeing a recent show on the show page, or you may be on an old page. Here's the format of today's show. The first half, we're going to talk about the news and the macro picture and other topics. In the second half, we're going to talk about the topic of the day, which is who are the consolidators in digital health. So with that, I just wanted to encourage the audience. You're welcome to ask questions in the comments, and I'll make every effort to address them quickly. So the first news of the day, I'll call it macro news. The macro environment is pretty positive. The NASDAQ was up today and is at 19.7 thousand points. So that means if 2 years ago, the only decision that you had made was to put your assets in the NASDAQ, it would be up 97% by then, and you would feel like a genius. So the NASDAQ continues to rise. So also inflation looks relatively tame. We're expecting further interest rate cuts, although that is still to be seen, and employment looks relatively good in the economies. And I think the next triggers that we'll see is, does the Fed stop cutting rates? It's in a cutting cycle. Or does the Fed keep cutting? And the market wants the Fed to keep cutting, and young companies want the Fed to keep cutting. So for our audience, if you have any questions about the macro environment, you can put them in the comments. So next, we're all still trying to make sense of what Trump's election means for healthcare, and more specifically for young software companies in healthcare who sell into the big budgets of healthcare. And I'll put a summary out there, and I'd love to get further ideas from the audience. But one thing Trump seems to stand for is less regulation in healthcare. That's a double-edged sword, but I think the business community in general welcomes the idea of less regulation. Less regulation could mean faster product development, lower costs in general. It can also, in healthcare, regulations are part of what make the products safe. And so we don't want there to be leeway for products to be faulty or dangerous. So that's the flip side of less regulation. Trump is also seen as a force for encouraging M&A across the whole economy. And this matters the most in of large companies, which is not the world of digital health. But the Biden administration was seen as being very anti-consolidation, anti-M&A, especially for large companies. And the Trump administration is seen as no longer opposing those acquisitions. And that has a trickle-down effect, so that the big deals get all the headlines, but young companies that are small are affected by the tone set at the top as well. And so in digital health, we've had under-consolidation for 15 years or more in digital health. We've had massive entry into the sector, but not a lot of shakeout and not a lot of consolidation in the sector. But there's signs we may be seeing an uptick in consolidation. That's part of what the main topic of the show is about. And so it's a good thing for the sector if the tone at the top for the largest companies in the general economy is that they can go ahead and continue with consolidation, mergers and acquisitions. That sets a more positive tone for digital health, which tends to be incumbents in healthcare, which are not the biggest companies in America, buying small software companies. So Trump also seems to be focused on cutting drug prices through potentially importing drugs from other countries where they have lower prices, and also through exposing price transparency. Price non-transparency in healthcare is used partly to keep drug prices high or keep people paying high prices for drugs. And price transparency could lead to companies losing the ability to practice discriminatory pricing and charge higher prices to people who can bear high pricing. So that's another step for Trump. But also I've heard some complaints of people talking about paralysis associated with Trump. And so why is that? Why would there be paralysis associated with Trump? Well, he's talked about repealing and replacing the ACA. This strongly affects how hospitals and health plans would operate. And as part of the innovation economy, we want to see hospitals and health plans feel confident about the future, feel they have spending money, and spend that money on software technology. We'd like them to see their software tech budgets stay the same or grow from year to year. And if Trump is talking about replacing and repealing the ACA, that certainly would cause paralysis, and budget decision makers inside of hospitals and health plans wouldn't know what the future holds in store, and they wouldn't want to spend extra on tech if that's the case, because it might be the wrong tech, for example. So another example of Trump paralysis is that RFK has talked about ending DTC advertising, direct-to-consumer advertising in pharma, that pharma is unduly influencing patients about drug prices, about a drug beginning to use prescription drugs. And so therefore, RFK could end DTC advertising. And pharma believes that this helps boost sales and therefore cash flow. And pharma is a big buyer of tech. And so if pharma thinks it's going to take a hit to its top line, this can cause paralysis in their making decisions to spend money on tech as well. And then vaccine safety, that's probably the issue that RFK is best known for, is saying that vaccines need to be safer. And here, many pharma companies make vaccines, and this creates uncertainty about, will they have to take vaccines off the market? Will they face interruption in their revenue from vaccines? And so those same pharma companies can be in sort of a defensive posture and spend less on tech. So that's an election summary. And so again, for our audience, for those of you who are interested, feel free to ask questions in the chat about macro environment or election news. So next, we'll talk a little bit about the valuation, fundraising, and IPO environments in digital health. So taking a look at valuation levels, the SaaS Capital Index is at 7.3%. That means that the enterprise values of companies for all public companies that are SaaS in America, according to SaaS Capital Index, is 7.3 times their annualized run rate. So, and this is near a historic average, but as recently as 2-3 years ago, it got as high as 17 times. That was those valuation levels that you have heard of. And private companies, a lot of private company deals 2 or 3 years ago got done at those levels, like 17 times run rate of revenue. And those companies are trying to figure out how to adapt to an environment where raising money is going to involve possibly a significant down round because of multiple contraction in valuations. But so SaaS Capital Index rate is at I say, about 7.3%, and that's near a historic average. And there's been a lot of speculation that we're going to see that fall because leading SaaS companies are going to be badly hurt by newborn AI competitors who are going to come in with a cheaper build base and fresher software and cannibalize them. And we haven't been seeing that. It's been relatively flat at 7.3 or roughly around there for several months now. And so next, moving on to the fundraising environment, I would characterize the overall, this is the fundraising environment for digital health companies that are at the stages of seed A, B, roughly. I would say that what we're seeing is a lot of disappointment by CEOs in the fundraising environment. So we know that venture funds have raised a lot of money. We know they have to put it to work. There's been a major retrenchment, a major pull-in of venture investing for 2 years. A lot of these funds have to put their money to work eventually. They have to put it to work in the next couple of years, or at least within 6 or 7 years of when they raised the money. And so they have to start putting that money to work. And CEOs are seeing slowness, reluctance on the part of funds to put the money to work. The funds are raising standards, saying that companies haven't met standards yet for a Series A or a Series B, etc. And this has been really tough on digital health company CEOs in the market. And there's been some hope driven by the Fed. So the Fed stopped raising rates and then started cutting rates starting a few months ago. And people thought this was the signal that was needed to reduce uncertainty in the markets and cause VCs to return to their old mindset in investing. And we have seen the Fed stop raising rates and lower rates, and we have not seen VCs speed up the pace of investment. And so we thought we'd see that in third quarter. We didn't see it in third quarter. We thought we'd see it in fourth quarter. The data is not out yet for fourth quarter, but it looks like it's looking like it's going to be closer to third quarter, which is to say flat and not an uptick, and not what people would have hoped for. People would have hoped to see a lift in number of deals per quarter of 10 to 20% in the fourth quarter. Probably not going to see that. What we are seeing, so every VCs seem to be being cautious about nearly every sector of digital health, with a few exceptions. Some of the areas that have benefited is companies across all sectors that are AI native. That's an area of enthusiasm. Also companies that are GLP-1 focused. So this is now we're talking about software companies with programs around diet and healthy living that include helping patients get GLP-1 drugs. Some other interesting areas include pharma tech, where pharma is seen as having a lot of money to spend on issues like clinical trial automation, and also revenue cycle management, where hospitals are seen as having an appetite for spending more on revenue cycle management after having spent more than a decade under investing in revenue cycle management. So those are some of our areas. Then M&A environment. So we've had a 15-year period of weak consolidation in digital health. A lot of entry into the sector, not a lot of sales in the sector, either trade sale to a corporate buyer, or sale to a financial buyer, or sale to the public in an IPO. But additionally, there is a belief that we're going to start seeing this M&A. There's a number of factors driving finally seeing M&A. And I'll get into some of those factors later in the call. But one of the reasons is that for a long time, young digital health companies had very high valuation levels. We saw just before talking about a 17 times revenue valuation level. A big consolidator comes in, sees that, and says, I'm not going to buy those young companies trading at those high valuation levels because they'll never be accretive to me. And so now if we see digital health companies starting to trade more in line with SaaS historical numbers, then we'll see some of those consolidators come in and say, well, I could buy that young digital health company at that lower valuation level. That could make sense to me. So we also saw, intriguingly, a few weeks ago, Omada and Hinge filed some documents with the SEC, which implied they're probably considering going public. And they had been talked about for years, actually, as being candidates for going public. And PitchBook published some research where they listed there's many unicorns in digital health that would like to go public. Their investors would like an exit. The CEOs would like to have two currencies, cash and shares, to go and do acquisitions. So there's many, but PitchBook named, in addition to Omada and Hinge, they named it ZocDoc, Row, Color, Everly, Noom, Lyra, Devoted, and some others. But there's many. Basically, any unicorn that's say over 8 years old, their investors would like to exit, and they would like to sell themselves to a consolidator or IPO to the public. So, and for our audience, feel free to ask any questions in the comments as well. So now I'm moving on to trade journal news. And here, a really shocking story today, just terrible news. The CEO of United Healthcare, who was apparently attending the investor day of his own company at a Hilton hotel in Manhattan, was shot outside the front door and killed outside the front door. And United canceled the rest of the day. And people are trying to make sense of this. It's really awful. The mayor has come out and said that they don't think this is random street violence in New York. There's a video. This was captured on apparently hotel video of this, but it looked like a targeted killing is what people are saying. And so really, just a shocking story, and people are trying to figure out, there's shock and mourning. And this, I think this happened very, very recently. People are, LinkedIn and Twitter are full of people reflecting on this and upset about this and trying to figure out if it means something for executives in Manhattan, or if it means something for health plans, or if it means something for healthcare. And it's too soon, I think, to speculate. So now next is I'll go through a couple other stories, and I like to follow fundraisers and try to make sense of fundraisers that are happening in digital health. And there's not been a lot of fundraisers over the last 2 weeks or so. I mentioned that was some of the disappointment. The trades I follow, I haven't seen a lot of fundraisers, but there have been some. But as I say, there's a belief and an expectation that the environment for fundraising has gotten better. And therefore, these funds that raise a lot of money that are not returning it to LPs, they need to put it to work. And we're still seeing continued slowness, continued hesitancy, even in a rate cutting environment that we're in right now. So then Nelson Mitchell asks a question: to what extent do you think a lack of exits is impacting VC investment? Yeah, I think VCs talk about this all the time, and there's an overall right now we're living in a great reckoning environment. So there were thousands of companies started, thousands of products launched over the last 15 years, huge amounts of capital entering the sector, digital health, huge amounts of talent entering the sector. And until recently, you could have a company and go raise a large round of funding at an even higher valuation with pretty low standards on the parts of VCs for what they would invest in. And then when the Fed began raising rates, it was like musical chairs, the music stopped, and all that came to an end. And it's been a tough environment ever since, and that's the reckoning that we're in. We're seeing a lot of asset sales, which usually means a distressed sale at a low valuation for the company and for the investors who invested in it. We're seeing a lot of products withdrawn, a lot of companies shut down. That's the negative reckoning that we're in right now. And VCs watch exits carefully, and they're very concerned. So exits tell them a number of things. An exit could be an IPO, and then when you have an IPO, the company is valued every day in the stock market, and so it means that some of their favorite investment theses that they were putting tens of millions of dollars into as recently as 2.5, 3, 4 years ago don't pay today. They won't provide a return today. They look into the public markets. They see an analogous company, a telehealth company, trading at 10% of its high, and they look at their private telehealth company in their portfolio, and they think about selling it and what it would sell for, and that public IPO company becomes a comp. And there's a lack of exits, and those exits that exist often have low valuations. And this is causing VCs to say, okay, I was comfortable investing on certain theses. Now I'm looking at valuation levels, and those aren't working. They're not working to invest today, and then exit if I can exit in the future, if my company is successful, if it can exit, and it's not going to give me a return that I need to ultimately give to my LPs. And then I don't know what theses will work. Well, there seem to be a few that they're converging on. They're converging on looking at new capabilities in products delivered by generative AI. That's one area of excitement. They think GLP-1s are going to be a big durable trend. They want to somehow get behind software products and programs around GLP-1. But yes, that's a great question, Nelson. There's a lack of exits, and the lack of exits is probably because companies that are old enough to exit by traditional metrics don't have good fundamentals. So if they had fat margins and growing top line at high rates and were clear to make tons of money, they would exit. They'd be desirable for consolidators, they would IPO, but instead they might have slow growth and weak margins, or be still negative earnings after 10 years, or with a plan for a better future, but having never really proved themselves. And so, yes, I think very much VCs are cautious and in a quandary right now, and some of their favorite investment themes aren't working. They don't have a lot of new ones that they think will work. Everything in healthcare seems to take longer than expected and cost more than expected. That's not good for ROIs for VCs in general. And so they're getting pitched on new opportunities, and they're more skeptical. So that's a great question. Thanks. And would welcome any more questions from the audience. So I'll look now at some of the stories. So interestingly, a company, Cofactor AI, raised a $4 million early round from Drive Capital. And their product is a product for providers that combats claims denials. So it's a convenient product, AI-based, that helps providers get back to the payer to address claim denials from the payer in a more automated, intelligent way. CEO here, Adi Tantravahi. So I guess the lesson I would take here is, first of all, this product addresses getting paid. This is on the revenue cycle management side of providers, not the clinical side. And that's a big trend that we're seeing. We're seeing that hospitals are ready to buy, providers are ready to buy AI products on the financial and revenue cycle management side, and they're often a little more cautious and going a little more slowly on the clinical side. And VC investors are more excited about near-term opportunities to invest in companies that have products on the revenue cycle management side for providers. So this, and it has an AI story. So this is one of the few deals that got done, and right there we're seeing revenue side of hospitals and AI product. Jonas writes, great to see you. Thank you, Jonas. Thanks for attending. So next, Practice Better. So Practice Better is a growth stage company. That means it's a little past, Series A. Practice Better has raised $13 million from CIBC Innovation Banking, which is not a venture fund. This is a growth stage company taking advantage of growth stage financing. And it's using the funding. Practice Better is a practice management platform for health and wellness practitioners. And it's using the funds to strengthen the company's platform with AI-driven features. So this is interesting. This is a company that has sales, it has market power, and it's now going back to raise money to strengthen its products using AI features. So it has to hire some developers, invest more than what's in plan into building additional product. So it sees an opportunity, maybe to sell more, maybe to fend off competitors. But once again, it's a fundraise with an AI-driven story. And for our audience, by the way, if you have any trade journal news, business news in the sector, feel free to put it in the chat and I'll react to it. Then also we saw, this is interesting, it's Zarman Ali Health, which is a hybrid care, multi-specialty pediatric practice. So that means that they're not a software company that is selling software. They are a medical practice. That is providing care and charging for care. And they raised a $40 million seed round from General Catalyst being a top mainstream digital health and multi-sector venture fund. And the company's going to use the money for go-to-market expenses and also for opening physical locations. So this is interesting. This is part of another trend for investors, which is in what I'll call this tech-enabled services and hybrid care. And so what this is in the past, usually it was doctors launched medical practices and hospitals, and they did not lead with a technology story, and they didn't get venture funding for these ventures. And they didn't need venture funding because fundamentally you ought to be able to get to cash flow break even in your first year. If you're providing a care service is high margin. You just need to rent facilities, have equipment, have licensed providers, and you can start generating, as long as you can get patients in the door, you're generating revenue immediately. No need for venture dollars for service businesses. But in healthcare, there's an argument that many VCs like that healthcare is well suited during the present time for investing in care services companies, technology-enabled services companies. And so we've seen a number of these deals. These are popular. And they might raise a lot of money. You can put a lot of money to work in these. So raising a $40 million seed deal, you don't see that very often. And the argument is that the white coats run healthcare services and they're doing a terrible job. That's the argument. And then the black turtlenecks, that's the tech people, can go raise $40 million and do a much better job and build a better platform and use the right software and do the right marketing. So supposedly those white coats, the doctors who run most healthcare services businesses, supposedly they're terrible at running a business, terrible at marketing, and terrible at buying and using the right technology products. And so when patients experience their care, it's a very old school, low tech care. And therefore, there's an opportunity for technologists and business suits to come along and take the market away from them, basically. So that's what we're seeing here. This has been a favorite of a number of funds to invest in technology-enabled services. So, and then Allurion Technologies, which is a weight loss platform, has launched a product called Allurion Meds, which is a product that will help give patients GLP-1 medications for weight loss in combination with its AI-enabled Coach Iris platform. So I've heard about the Coach Iris platform for weight loss. The CEO here is Shantanu Gaur. But this is an example of what companies are launching, and what's getting funding is not just the GLP-1 drug under the care of a physician, but a company that has a program, an AI coach, an online program for overall certain kinds of weight loss. They're trying very hard to rapidly add the ability to add in a GLP-1 drug, either that's prescribed by somebody else, by an unrelated physician, or it could potentially be prescribed by an on-staff physician of the company. So I think that the kinds of deals that have gotten funded or products launched in the last 2 weeks is actually very illustrative of what investors are looking for right now. These have lined up, the ones I've seen have lined up very tightly with the themes, the successful themes we're seeing today. So let's see. So Doug asks, in the current market, do you have a sense of whether investors are placing more emphasis on revenue growth or profitability within their portfolio companies? This is a great question. And I think that in general, there's been a wave of VCs telling founders that they need to belt tighten. So what belt tightening means is you're cutting back on exciting product development. You're cutting back on aggressive sales. And as a result, you can extend your runway. You can belt tighten and you can extend your runway from 1 year to 3 years. And you may need that to weather the storm, to keep successful control of your own destiny and not run out of cash. And so that's emphasizing improving margins, or if that's not possible, that's emphasizing extending the runway. And it's not emphasizing high growth at all costs. So this is a tough call for CEOs because there's a number of things that can happen here. One thing that can happen is that they've got 9 competitors, and one of their competitors has privileged access to capital. And so they raise money, they keep exciting product development going, they keep growing top line aggressively, they hire the best salespeople, they poach the best salespeople, and then they win in the competitive marketplace. And so that would be an awful thing to happen if you belt tightened and couldn't spend for growth, and one of your competitors could keep spending for growth. Another thing that happens is that companies now have to go out and try to raise their next round. They extended their runway by a year, but now they have to go out and raise their next round. And they're growing top line slowly. And so investors are saying, why would I invest in you? You grew 70% top line 2 years ago, but for the last 2 years, you've been growing top line at 15%. You're not a high growth company. Why would I invest in you? And the answer is they belt tightened, and they did what investors told them to do, which was a very reasonable choice at the time. But now they're not able to go into investors' offices today as a high growth company. So I'm still seeing, for the vast majority of companies, this emphasis on extend your runway or show that you have good margins or will get to good margins. And it's also, not coincidentally, it's a risk-off environment in the stock market. The stock market is rewarding safer companies, less risky companies in the stock market. That's trickling down. I think it's probably different in established AI businesses. So I'll take hospital billing as an example of an established AI business. This is only 2 years old, but already there's a number of entrants growing fast in hospital billing using generative AI. And in that business, I think we're seeing that. So everyone knows that generative AI has a lot to offer in hospital billing, and that these new solutions are going to beat the old solutions and take over the market. And so in that case, that's one of the most favored cases right now. It's back to VCs are excited. They want to put money to work. Companies are emphasizing top line growth and get big fast and don't worry about margins until later. So thanks, Doug. That's a great question. I'd say 80 to 90% of categories, there's still an emphasis on show you're going to get to cash flow positivity and have good margins at the expense of high top line growth rate. But for the most favored sectors, it's booming like it was 3 years ago again, like it was the bull market of 2021. So any other trade journal stories, feel free to put them in the chat. So then I'll talk about upcoming conferences. So I think the conference everyone is talking about right now is the JP Morgan Healthcare Conference in San Francisco is coming up. And then after that, Vive and HIMSS are coming up. So HIMSS is for hospital CIOs. and Vive is for payer and provider executives. And JP Morgan is a pan-healthcare conference. And JP Morgan is a really unusual conference. It's an investor conference in downtown San Francisco. It's so unusual because the vast majority of people who go never got a ticket from JP Morgan, and they're not going in the Westin St. Francis Hotel either. They're simply going in, they create their own agenda of creating meetings, and they meet people in hotels and cafes around Union Square. And so my message for the digital health community is, and the JP Morgan conference is falling a little bit out of fashion now because people went to health in Las Vegas instead and had a better experience at health in Las Vegas instead. A lot of innovation companies in healthcare at the health conference, a lot of VCs at the health conference. So with that successful experience in October in Las Vegas, people are feeling there's not a reason to go to JP Morgan. But JP Morgan has enormous inertia, and so some people are still going. So I would say if you did not accomplish your company's fundraising or business development and sales prospecting objectives at health, you should be considering going to JP Morgan. And it's the second week of January in San Francisco. Many VCs, San Francisco VCs and national VCs are attending. It's worth it just for that. Stay in touch, bring some news about your product development, your sales. And then the way you do it is you make a list of everyone you want to meet, ideally over 100 people, and then you write all of them and you say, let's meet. And there's a good chance that they'll be there, and there's a good chance that they'll meet. They'll say, let's meet. And you want to try to meet do about 8 meetings a day for 3 days, Monday, Tuesday, Wednesday. That's 24 meetings. And so to get to 8 meetings a day, you have to send out messages to over 100 people. And you need to send out those messages right away. I mean, literally, you should be sending out those messages this week or next week, asking people to meet at JP Morgan. So that's the JP Morgan conference. If you guys have any questions about conferences you're thinking of going to, or questions about these conferences I've mentioned, feel free to throw them in the chat and I'll address them. And let's see, I've also heard of the Piper Sandler Health Conference in New York City in early January. That's an investor conference. That's one where it could be worth going if you can get an invitation from Piper Sandler. And then there's Vive and HIMSS coming up. HIMSS is a trade show and an investor conference, and Vive is meant to compete with them, and it's an innovation conference for payers and providers. And I like both of those conferences, and Vive is run by the same people who run health, and it's positioned to sort of take market share away from the HIMSS conference. And Vive is good at getting investors as well. Payers or providers, as an innovative digital health software company, Vive would be a good conference to have on your list. So and those are coming up in the January, February, March timeframe. So again, I'll ask our audience any questions you have for me about these topics. Feel free to throw them in the chat. And then, so I have a few more shows. I have another show coming up December 18th on what are the changing preferences of software buyers in digital health. So that one's coming up. Love to see you on that show. Feel free to sign up on that show. My Eventbrite page is stephenwardell.eventbrite.com. You can register there. And also I'll be having one of my investor innovation nights in Boston, January 23rd, the evening of Thursday, January 23rd. We have coming up with an MIT professor of genetics and AI, Manolis Kellis, talking about a genetic model of disease for our audience there. So that's coming up in Boston in January. So with that, I'm now going to move on to the topic, who are the consolidators? So digital health sectors are maturing and consolidators are starting to circle. And, have we started the game of musical chairs? So there's been a tremendous amount of entrepreneurs entering healthcare and digital health since 2009. But in that whole time, the amount of consolidation across the whole sector has been weak. And I've actually been saying that there's been weak consolidation in digital health, and that I expect there'll be better consolidation in digital health since around 2015. So for quite a long time. And oddly, we have bucked the trend. So nearly all sectors of the economy go through stages of growth and entry, followed by consolidation, and digital health has had weak consolidation for a very long time. And so it's overdue that we would have a consolidation. And so let's see. Now, first I'll speak to some trends. And for our audience, would love to hear your views on this. I think that we've seen acquisitions here and there, but we have not seen the beginning of the game of musical chairs. We've not seen the beginning of a real uptick in consolidation among digital health software vendors that sell into the big budgets of healthcare. But I think that we're going to start to see that. So the first thing I'll mention is that valuations have been very high in digital health for young, fast-growing software companies for a long time. Since 2009, valuations have been very high. And this was driven by the Fed's ZIRP policy, the Fed's zero interest rate policy. And now that the Fed has raised rates faster than ever before, it's raised rates up to a little under 5% for the risk-free rate. This has caused a pull-in, a contraction of multiples, a pull-in of valuation levels. Well, those high valuation levels for young, small, fast-growing companies that were earnings negative, that really prevented consolidators from buying companies for years and years. And so only with valuation multiples contracting and valuation levels coming back down to historical norms and interest rates having preceded that going up and wrecking the high multiple environment, we've been seeing that, and that is a good groundwork that has been laid now for consolidators to come in and buy young digital health companies. So the groundwork is being laid, has been laid for there to be an appetite on the part of consolidators to buy young companies. In addition, I'd say the biggest single factor affecting most parts of digital health is what I'll call maturity. So it used to be the case that an innovative company with a point solution was coming in to a healthcare market, and there were few competitors, and it had a lot to offer with its product. It was offering automation for the first time, digitization, smart systems, that sort of thing. And that was enough. But I think now, and buyers were being delighted by having big, nasty problems causing a lot of pain for doctors or a lot of paperwork for institutions. They were delighted to see these software solutions come along that were automating it and solving the problems for the first time. Well, that's not really what we're seeing so much anymore. Instead, now we see market subsectors with several competitors, and buyers are becoming mature and sophisticated. That's one of the biggest things. It wasn't true 10 years ago. It wasn't true 20 years ago. It's increasingly true today. And when those buyers become more sophisticated, what they often want to do is they want to pay less for what they're buying. They want to see suites. They want to see consolidated technological platforms. They want to see meta functionality across all products. So functionality is things like our product lowers A1C levels in diabetes patients. Meta functionality is things like we have single sign-on, or we guarantee IT security across our products, or we gamify all of our products, or we have the complete suite of products from one vendor. We run analytics across all of our products. That's meta functionality. Buyers become more sophisticated. They want to pay less. They want to buy suites and not have to do that are pre-integrated. They don't want to do the integration themselves. And so we're seeing that, and that tends to be, and that means a number of things. First is that it tends to benefit larger players who already have suites, and it tends to disadvantage younger, smaller players who just have a point solution with a high basic functionality. It's not enough to have high basic functionality in your point solution. The buyer will say, I'd rather buy this suite that has 6 of the products that I want in it that are integrated and with each other, etc. And I'm not impressed that your diabetes solution has a bigger A1C level effect anymore, because the one I'm buying in a suite is good enough. So I would say maturation is one of the big effects, and this is happening especially in the employer health tech sector. So the employer health tech sector is a sector that includes companies like Teladoc, Accolade, Omada, Hinge, Personify, and others. And that's the sector where buyers are maturing. Also, the health tech sector, which is the sector of software and tech companies that sell into healthcare provider budgets. I'm sorry, I meant to call it the provider tech sector. The provider tech sector, this is like hospital CIOs buying EMRs or hospital CFOs buying revenue cycle management. That sector is increasingly becoming more mature, and buyers want to do enterprise buys and buy suites and that sort of thing. So those are one of the big trends is maturation. Another trend is what Alyssa Jaffe and Chrissy Farr wrote an article recently, and I'm going to bring them on this show as well in a few months, but they're calling it scale gain. And what they mean by scale gain that's happening is that the big incumbents that we sell to have become much bigger over the last 5 years. On average, some of them have become 100% bigger over the last 5 years. So Lilly, the drug company, United, HCA, they've grown much bigger. And as such, they can't deal with small companies anymore. They want to buy from vendors who can solve big problems for them. And so this is Alyssa Jaffe and Chrissy Farr are predicting that this means that bigger vendors need to buy smaller vendors in order to scale up, in order to be able to sell successfully against other bigger vendors to the big incumbents. So maturity, scale game, rising interest rate environment leads to lower prices for young growth companies. This is some of the factors that are happening in the market. And any questions about this from our audience, please go ahead and and ask them in the chat. So next, I'm going to go into the categories of consolidators, how to think about who consolidators are in the sector. And I think there's basically three categories of consolidators. And the first, I call them the innovators or the big vendors. So the innovators, this is like Teladoc is itself a vendor that is less than 15 years old. And Teladoc bought Livongo. So Teladoc is a public company. It's a consolidator. It bought Livongo. It bought a number of other companies. It has slowed down the acquisition pace because of the acquisition of Livongo, I've heard. But Teladoc remains a consolidator. But these are the innovators, and you can also think of them as big vendors. Personify Health is the combination of Virgin Pulse and HealthComp. So Virgin Pulse buying HealthComp, basically. Pulse is a consolidator, and I call these the innovators, and another word for them is the big vendors. The big vendors buy small vendors. So we should track these companies. The next is what I'll call the incumbents. So incumbents are longstanding, very large healthcare incumbents. And so these are companies like United Healthcare and their subsidiary Optum. Optum is a big consolidator, has acquired many companies, many digital software companies. HCA bought PatientKeeper back in the day. So HCA is an incumbent. Merck is an incumbent. Lilly's an incumbent. So, and then thirdly, I think that another consolidator category is big tech. So with big tech, these are companies that they have B2B and B2C divisions, and they're often have a little bit of healthcare, but not a lot of healthcare. And their board is often pushing them. Their board perceives healthcare as a very large sector of the economy where products can have higher growth rates than the overall economy and sustain higher margins than the overall economy. So if you're on the board of a big tech company like Microsoft, why wouldn't you tell the CEO to get more into healthcare by acquisition or by organic growth or whatever? And so this is companies like Microsoft, which bought Nuance, which Nuance's biggest products were all in healthcare. Google buying Fitbit is another example. Oracle buying Cerner is another example. So these are the categories of consolidator. Innovators, which are also called big vendors. Incumbents and big tech are the categories of consolidators. And then there's the different subsectors of digital health. So, and these consolidators, it's very different across different subsectors of digital health. So here are the subsectors of digital health that we'll talk about today. The first is provider tech. So provider tech is software and tech digital health companies that sell software and tech products into the large provider organizations. And so this is like EMR vendors like Athena Health selling EMR software into hospitals. So or clinical decision support software companies selling their software products into provider organizations. That's the provider tech sector. Then there's the employer health tech sector. So this is software and tech companies that sell into the employer health tech budget, usually the benefit leader at the progressive large employer. And this is companies like Accolade, Personify, Teladoc, Omada selling into large employers. Then there's the payer tech community, the payer tech subsector. And this is software and tech companies that sell into the budgets of payers. This is like Cotiviti and Inovalon and eHealth and HMS selling into the budgets of payers. And then there's the pharma tech subsector. And so this is software and tech companies that sell into the budgets of pharma and life science companies like med tech companies or diagnostic companies. And this is like Medidata selling clinical trial automation software, or Veeva selling specialized CRM software into pharma and life science companies. And then there's a couple others sectors, but I'll focus on those four to begin with. Now I'll jump into talking about these subsectors and who are the consolidators in those subsectors. And in some cases, there's some level of activity it's always nice to see sectors where the consolidators are already active doing consolidating. But in the case of digital health, it's few and far between. Most of these sectors, there are a good number of potential consolidators that are well positioned to consolidate, could be contacted to ask about buying a company, but most of them are not very active. And the reason they're not very active is that they saw overpriced digital health companies 3 years ago and 2 years ago, and then they went through the same sort of shock of the Fed raising rates everyone else did. And we haven't started the game of musical chairs yet to really begin consolidation. That I'll also throw it out to the audience. Feel free to ask any questions about subsectors and companies and consolidators and that sort of thing. I'm happy to address that. So first we'll look at the employer health tech sector. So this is vendors like Teladoc, Accolade, Omada, Castlight, Health Equity selling into the employer benefit budget. So here, one group of potential buyers of consolidators is HR tech and ERP companies. So HR tech and ERP. This would include SAP as an ERP company, or Microsoft and Oracle's PeopleSoft, and even Fidelity, which offers HR benefits, and HSA Bank, Optum Bank, part of Optum, Workday, ADP, Cornerstone On Demand. These are some of the companies in ERP and HR tech. Interestingly, there's also health benefit consulting firms, sometimes actually acquire young, innovative companies. And that's like Towers Watson, Marsh McLennan, Buck, Aon, Hewitt. And then there's also health plans as acquirers of employer health tech companies. So here there's like United and its subsidiary Optum, which bought Able2 and others, CVS, Aetna, Anthem, Humana, Cigna. These are health plans that from time to time buy digital health companies that sell into the employer health tech space. And big tech, there's Amazon, Google, Salesforce, Oracle are companies that have bought in the employer health tech space before. And then there's the innovators, or the big vendors themselves, who could be acquirers of smaller vendors. And here you've got Teladoc, Sharecare, eVive, Accolade, Transcarent, Omada, Quantum Health, Collective Health, Solera Health, Personify Health. And a good sign with these vendors is if they've raised a lot of money, they've gotten recent support from investors with a big round, or if they're reported to go public or have gone public, that makes them a better candidate to be an acquirer. They have a source of financing they can use to go around and buy younger companies to build out better suites to be able to sell better to buyers. So then that was the employer health tech sector. So the next is the payer tech sector. So this is software and tech companies that sell into payers' budgets. This is budgets like budgets for improving your HEDIS rating, or budgets for making your Medicare Advantage plan more competitive, to buy tech products to do that, or for claims management. And so here, consolidators include the big payers themselves. That's like United and Optum, or Humana, CVS, Aetna, Anthem, the Blues, Cigna. Also, big tech would buy some of these payer tech companies like Salesforce and Oracle, and PBMs could also buy payer tech companies as well, especially if they are vendors that sell into PBMs. So next is provider tech. And here, so provider tech is software and tech vendors that sell software and tech products and services into the big provider budgets of providers, hospitals, medical practices, etc. And so this is companies like Athena Health, or Veradigm, or Cerner, or Epic, or Cario, Modernizing Medicine, and others. And Some of the buyers include big tech. So big tech includes Microsoft or IBM or Apple, and then there's also big vendors as well. So big vendors would include like Phreesia or American Well or Epic, although Epic is actually, so Epic would be an obvious buyer. It's a EMR and rev cycle management company that is knocking the ball out of the park, but they are well known to be not big acquirers of young companies. So that's actually an issue in this sector, is that one of the most obvious buyers structurally is not a good buyer actually. They tend to like to build products themselves. So big tech and innovators, big vendors, are some of the buyers for provider tech. Then there's also the pharma tech sector. So the pharma tech sector is the sector of software and tech companies that sell into the big budgets of pharma and life science. And that's companies like Veeva, Komodo, Model N, Flatiron, which was acquired. And some of the buyers here include big pharma and med tech companies. So this is like Merck, Sanofi, Boston Scientific. They sometimes acquire tech companies. Roche acquired Flatiron, as an example. And also CROs and data vendors. And that's like IQVIA is an example of a CRO or data vendor acquiring digital health companies. So that is a bit of an around the world of how to think about the different kinds of consolidators, the different subsectors of digital health, and who the companies are within those subsectors who fall into those categories of consolidators. So with that, I'll check in with our audience and see if you guys have any. And within this, I think there's another show's worth of content about taking apart the relatively small number of deals we see in this sector and what we can learn from them and what we can expect, which large companies seem to have an appetite to begin acquiring and which vendors look most attractive to them. So with that, I'll see if anyone else has any questions. And if not, we'll wind up the show relatively soon. So I'll hold it out there to see if there's any more questions. Well, it looks like we don't have any more questions from our audience. So, I'll end on an optimistic note, which is that there's been massive entry into the sector, but there's always been under consolidation. And the under consolidation was fundamentally driven by the Fed pursuing a ZIRP policy, a zero interest rate policy. With zero interest rates, the multiples of growth companies, and all digital health companies are growth companies, went up astronomically. We saw earlier in the show that the multiple went from 7 times revenue to 17 times revenue. And at those higher multiples, consolidators simply couldn't buy young companies that were often had zero earnings or negative earnings. And those acquisitions would never be accretive. The multiples were too high. The multiples that were generated by VC investors giving higher valuations to the next round of the company didn't make sense to consolidator buyers, and the acquisitions would not be accretive within 2 years or ever. So it didn't make sense for buyers to buy. But now the table is being well laid, which is to say that rates have gone up and multiple values on growth companies have come down as a result. And also, unfortunately, some young companies are running out of money finally. They're reaching the end of their runway, and they're ready to sell. They realize that selling to a consolidator, they would have held out for a high valuation in the past and not sold. Today, they're realizing that selling to a consolidator early in the cycle of consolidation is one of the better bets they could make. And consolidators are looking and saying, our product buyers want to buy suites. We need to buy winning young companies that fill out our suite. And their prices have come down to buy the company. Their multiples have come down. And so it's time for us to go out and make some of those acquisitions. So Doug raises just an observation. It's interesting that Amazon isn't a digital health consolidator. That's a good point. They have done some work. People are very interested in what Amazon has to offer. So I think first you'll notice that they sell an enormous amount of healthcare products on their website, and they have a pharmacy, and they will even sell devices that require a prescription on their website. So you need a prescription to buy a CPAP machine, for example. You can get your pharmacy filled by them. They did acquire PillPack, and people thought that a logistical genius like Amazon would acquire PillPack, and that would become a very common mass scale product, the special way that PillPack handles prescriptions. And it did not. Sadly, I think a lot of people might have liked to have used the PillPack product at Amazon, but they did not figure out a way to scale that rapidly. And then Amazon also bought One Medical as well. One Medical is a technology-enabled services company, not necessarily a digital software company, but that seemed to be in line with Amazon's. They bought the high-end Whole Foods, and they were buying the high-end One Medical as well. And I think Amazon has SaaS and web services is a huge part of the Amazon business. Just selling storage, compute, publishing on the web to other tech companies. And within that, many tech companies have chosen to go on the Amazon web. They've been very happy. Amazon's been very competitive compared to Google and Microsoft and others. And so that's a big part of Amazon's business. And so we're all watching what Amazon is doing. We watched Walmart, CVS, and Walgreens get into primary care. And then in the last year, all three of them stumbled. CVS stumbled in primary care. Walmart stumbled in primary care and is exiting primary care. Walgreens stumbled in primary care with VillageMD. And we also saw Amazon get into primary care with its acquisition of the provider I mentioned before. I'm blanking on its name now. And Amazon hasn't really stumbled with that acquisition. So Amazon has the capability to be a big tech consolidator. It's made those two major consolidations that I mentioned, PillPack and the primary care provider, and we'd like to see it do more. And so, but thank you for that. So with that, you've been listening to Digital Health Investor Talk with your host, Stephen Wardell. We are publishing this show as an episode of the Digital Health Investor Talk show. You can subscribe to the podcast on Apple and Spotify, and don't forget to rate us. And for our Boston audience, we have a health innovation night coming up Thursday, January 23rd, with MIT's Professor Manolis Kellis, the professor of computer science and genetics, talking about a genetic model of disease. And for those of you going to the JP Morgan Healthcare Conference, I'll see you. I'm headed out there. I'll see you out there. Feel free to reach out to me if you'd like. Maybe we could meet for a drink at JP Morgan. And with that, thanks, and I'll see you on the next show. Bye-bye.